This is a proposal that addresses the maintaining the United States balance of trade by the applying a value-added tax to each business. It applies weight based on each individual company's trade balance. This also eliminates the need for restrictions based on individual products. It does not ignore consideration for maintaining a level playing field.
A system that rewards behaviors that benefit the United States and the people, is the system's objective. To do this, business tax rates are based on each individual company's balance of trade. Value added to products, based on the source of goods and services is used. Rate adjustments are made based on the percent of value added to products by the use of imports is used. This is done as needed to maintain a 4% national annual unemployment. No income taxes on individuals' wages of less than $150,000 a year will be collected. Some things may cost more, but with no taxes on wages there should be a substantial net benefit.
Taxes on each business is based on their individual trade balance. On the left is the products and services that originate outside the United States. On the right are the products, materials, and services that have value added in the United States. These include finished goods, component parts, technical and design services, support services, transportation services, labor, facilities, employee benefits, raw materials. All products maintain a value that measures its balance of trade ratio that follows it through the supply chain. Financial taxes are calculated differently. Here is the basic rules for businesses. Value added is the basis of taxes instead of profits, which will eliminate complex tax deductions. This gives us a vastly simplified method of taxing. The goal is to give those companies that contribute more to the United States economy reduced taxes. Note, there is a lot of history and discussion available on ways that the value-added tax works and will not be discussed in detail here. Ways tax rates are adjusted to incentivize United States investments. Rates are based partly on ratio of value added domestically and from the rating of our trading partner. Exports to the same country cancels out imports. Overall import adjustment to tax rates are automatically applied to maintain a low 4% unemployment rate. Weighting for class of country. Favored trading partners like Canada are treated like domestic production. Several trading groups of countries are set up with different tax weighting based on how workers are treated and paid. Is the environment protected? Are trading rules followed? Is there a level playing field between countries? Individual taxing. Earned wages up to $150,000 per individual are not taxed. Employers continue to withhold Social Security and Medicare health insurance premiums. Other income that is taxed. Small business. Investments and capital gains. In addition, a 5% charity to qualified organizations of the person's choice are withheld and distributed. Notes on interest income and capital gains. Interest income is progressively taxed. Domestic institution financing income is exempt, but their services are not. Capital gains are taxed based on time held.
Other ways for us to evaluate the benefits and make adjustments that influence our trade balance. We should measure and evaluate our trade balance not only based on money, but we should compare the labor hours needed to make the products. Keeping both product costs and unemployment low while not exporting jobs is our objective. Business models should be adapted to benefit the USA if they wish to compete domestically. Micro-control by our government should be replaced by a system that uses capitalism to automatically influence businesses to make decisions that adjust sourcing decisions. Global trade is needed to provide the best standard of living possible. We just need a structure that provides incentives to guide decisions by companies on sourcing their goods.
This ends this presentation. There are obviously many ways this method of controlling imports and taxing can morph into. Let this be a beginning of a discussion. By Philip Myers, August 2, 2016.